A bank and a credit union can sit on the same street, same checking account, same debit card. One of them is owned by investors you will never meet. The other one is owned by you. That difference sounds like paperwork. It quietly decides what you pay to borrow and what you earn to save. It also decides who keeps the profit at the end of the year. So here is the short answer. A bank is a for-profit company owned by shareholders, and it exists to make money for those shareholders. A credit union is a not-for-profit cooperative owned by its own members. What it earns comes back to them as better loan rates and lower fees. Same services, different owner, different incentive. That is the version that fits on a napkin. The reason it plays out that way is stranger. It involves a tax break from 1937, and banks have been trying to kill it ever since. There is also one number most people have backwards. Credit unions do not beat banks on everything. The place they lose is the account almost everyone opens first. I will get to the federal data on that in a minute. By the end of this, you will know which one actually costs you less. You will know why you might not be allowed to join one of them. And you will know the one rule that decides whether a credit union can take you at all. Start with who owns the building. When you open an account at a bank, you are a customer. The bank has shareholders somewhere else, and its legal duty runs to them. If the bank earns more than it spends, that surplus becomes profit. The profit belongs to those investors. Open an account at a credit union and something different happens. Your deposit buys you a share. You are a member and a part owner, and you get a vote. One member, one vote, whether you keep $200 there or $200,000. That detail surprises people. At a company, the biggest shareholder wins the vote. At a credit union, the wealthiest member has the same say as the newest one. The board is usually volunteers elected by the members. So a credit union sets its own overdraft fee. The people making that call answer to the same members who would pay it. That is the whole engine. Everything else runs downstream of it. So does member ownership actually show up in the numbers? It does, and the referee here is the federal regulator itself. The National Credit Union Administration publishes a straight head-to-head table of average rates. Take the third quarter of 2025. A 60-month new car loan averaged 5.64% at credit unions. At banks it was 7.47%. Used car loans 5.59 against 7.74. A classic credit card 12.71 against 15.46. Those gaps are close to 2 full percentage points. Put that on a $30,000 car loan over 5 years, it is roughly $900 to $1,200 staying with you instead of going to a lender. Now the part that gets left out of most advice. Look at a plain savings account. That same table has banks paying 0.33% and credit unions 0.20%. The banks win that one. So the rule is not that credit unions always pay more. They are consistently cheaper when you borrow. Banks were paying slightly better on the simplest savings account there is. That is the trade. If credit unions are cheaper to borrow from, why is everyone not in one? Because a credit union is not allowed to serve everyone. Every credit union has something called a field of membership written into its charter. Federal ones come in 3 shapes. A single common bond serves one employer or one association. A multiple common bond serves several of those groups. A community charter serves people who live, work, worship, or study in a defined area. A bank has no equivalent rule. A bank will take your money if you walk in the door. But the gate is softer than it sounds. Immediate family of an existing member usually qualifies. So one relative can bring in an entire household, and plenty of credit unions attach themselves to an association anyone can join for a small fee. So here is the honest version. Membership is a real extra step, and most of the time it is a formality. Look closer and it is paperwork, not a wall. Here is the question that stops people from switching. If it is not a bank, is my money a safe? Bank deposits are insured by the FDIC. Credit union deposits are insured by the NCUA through its share insurance fund. Both cover $250,000 per depositor, per institution, per ownership category. Both are backed by the full faith and credit of the United States government. Those numbers are not similar. They are identical, and neither system has ever cost an insured depositor a cent. The one thing worth checking is that the credit union is federally insured. Almost all of them are. The notice is posted at the door and on the website, so safety is not the deciding factor here. It is a tie, and anyone telling you otherwise is selling something. Which brings us to the objection that used to settle the argument. Credit unions are small, so you will never find a branch when you need one. That was true, and it has aged badly. Credit unions share their branches with each other. The shared branching network covers around 5,600 locations. Add more than 30,000 surcharge-free cash machines, pooled across 1,600 credit unions. For scale, Chase runs about 4,700 branches. Wells Fargo runs about 4,400. So a small credit union can hand you a bigger footprint than the biggest bank in the country. The catch is that it only works if your credit union takes part. Not all of them do. The real weaknesses sit somewhere else. Smaller credit unions are often behind on the mobile app and the online tools, and they tend to offer less. Business banking, investment services, and premium rewards cards are usually thinner or simply missing. That is the honest trade. Cheaper money, occasionally clunkier plumbing. There is one more piece, and it explains where the cheaper money comes from. Federal credit unions pay no federal income tax that is usually credited to the Federal Credit Union Act of 1934. That is not quite right. The 1934 law created the system. The tax exemption arrived in an amendment 3 years later, in 1937. The reasoning was that a credit union is a cooperative. Its earnings already belong to the members who produced them. Taxing it would be taxing the same people twice. Banks have argued against that for decades. Their case is that a modern credit union holds billions in assets. It looks like a bank and competes like a bank, so it should not skip a bill the bank has to pay. Credit unions answer that the exemption is exactly what funds the cheaper loans. Nobody has settled it. It returns to Congress every few years, so the rate gap you just heard is partly a policy decision, not purely good management. One last number tells you where all of this is heading. In the first quarter of 2026, there were 4,250 federally insured credit unions. A year earlier, there were 4,411. Over that same stretch, membership climbed to about 145.8 million. Fewer institutions, more members. They are merging into larger ones that look a little more like banks every year. So, stripped all the way down, a bank works for its shareholders, a credit union works for the people who bank there. That one difference is why a credit union is usually cheaper to borrow from. Knowing which of the two you are standing in tells you whose interest is being served. That is worth knowing before you sign anything. So tell me in the comments which one you are with. Did the rates match what you just heard?